Hello. All right, this is the first of many videos that you guys are going to get from me. So this is chapter 6's lecture notes. I felt like we kind of started it, and I think we did, but everything's been pretty crazy and we haven't done anything in 2 weeks. So I kind of wanted to start at the beginning and go back through it, and I'll kind of remind you of where we were before. You guys should all have your chapter 6 blank notes printed. If you don't, you can pull them up on the computer while you're viewing this. If you have two devices or however you want to do it. So maybe you can pull it up on your phone and watch it on your phone while you record on your computer, or I don't really know. So let me share my screen. I can't wait to see you guys tomorrow. All right, so I'm sharing my screen and I want to make sure that I'm recording. So I'm going to go back and make sure. Just a second. I stopped my share while I was recording. All right, I'm just making sure I don't want to do this twice. Um, so back to this. And so what I'm going to do is I'm going to pull up our chapter 6 lecture notes, and I'm just going to walk through these and fill in the blanks. And so you guys can fill them in with me. After I finish this chapter 6 lecture, you'll be ready to do the chapter 6 homework. So chapter 6 is all about inventory. And of all of the things in our business that's stolen from us, inventory is a close second behind cash. Cash is the easiest thing to steal because there's no way to trace it. But inventory in our store is stolen pretty frequently as well, either by our customers or by our employees. And so this chapter and the next chapter are all about inventory. And what we're going to do is we're going to try to learn about how inventory is recorded, and as we sell it, how do we pay attention to that? So quick review, the three types of businesses are service, merchandising, and manufacturing. So primarily in this class, we focus on a merchandising business. So we just buy stuff and then sell it to someone else. When you guys take managerial accounting, and many of you guys will be taking that next semester with me, Tuesday, Thursday at 9:30. When you guys take managerial accounting, we're going to focus almost exclusively on manufacturing companies. So as far as internal controls, we're trying to protect our inventory against theft. So we do that by locking up certain kinds of inventory, by having cameras to see if people are trying to steal stuff, by having good operations for when we buy inventory and making sure that we don't pay for it till we receive it and that kind of stuff. So as far as inventory management, inventory is a really hard thing because you need to make sure you always have enough inventory on hand, but you don't want to have too much. So think about if you were like Target and you're trying to get ready for Black Friday and you're going to put TVs on sale. So 60-inch TVs on sale. You need to have enough so that when a customer comes in to buy one, you have them. But if you have too many, you have to store them, and then you have to figure out what to sell them for after if they don't sell, and are you going to have to mark them down? What are you going to do? So you need to have enough, but not too much. So it's a pretty interesting part of all of this. So when you sell inventory, we call that cost of goods sold, which stands like we use the abbreviation COGS, cost of goods sold. So that is the cost of the item that you are selling. So let's see here. We talked about perpetual versus periodic inventory. Perpetual means continual. And I think when I explained that to you before, I said perpetual always makes me think of my church back home because its name is Our Lady of Perpetual Help in Concordia. And so perpetual means you're continually tracking your inventory. And I think I made reference to the ketchup manager at Walmart sitting in the back room and watching the ketchup inventory going up and down. So as people buy bottles of ketchup and they scan them through the self-checkout or regular checkout, you can see the balance decreasing. And then as it hits a certain level, another box of ketchup would be ordered. As that box gets checked in to the back room, the balance of ketchup would go up. And you could be like, you could look at any inventory item in Walmart and you can see the balances going up and down. That's called perpetual, continual inventory. So inventory and cost of goods sold are always up to date. So periodic means every once in a while. So what that means is we only record updates to inventory at the end of the accounting period. So at the beginning of the accounting period, we know how much inventory we have on January 1. And then all through the year, we buy more, we buy more, we buy more. but when it leaves the register, we don't track which items leave. So the only way to know if we need to order more inventory is to actually go out to the shelf, look at the shelf and be like, we're running low on ketchup, order some more ketchup. And so we assume the reason why we're running low is because somebody bought it. But that's not always the case. And so I think I remember that we used an example with bolts, and we said Selena was a crazy bolt stealer. And we thought we were selling bolts, but we weren't actually selling bolts because Selena was taking them home with her. So same thing with ketchup. Maybe somebody's stealing all the ketchup. I could, because my kids use ketchup constantly. So, all right. So the inventory count, the only way to know how much inventory you have is to physically go count it on the shelf. And so then you know what you started with, then you know what you bought, and then you count what's left, and the difference is what's sold. So a few things more about inventory. Usually there's just one inventory account on your balance sheet, but if you're a manufacturer, like we're going to learn about in managerial, you actually have 3 different kinds of inventory. These are all assets on the balance sheet with debit balances. And if you were sitting here, I'd be harassing you like, all right, what kind of account is inventory? It's an asset. What is an asset of a balance of a debit or a credit? And you guys would tell me, but you're not here. I'm alone in my bedroom making videos. So raw material is a kind of inventory. It's pieces and parts. So in managerial, we make bicycles a lot. And so what we'll do is we'll be like, all right, we have handlebars and seats and frames and wheels and stuff, right? Tires. So all of those pieces and parts are assets, because eventually we're going to turn them into a bike and then we will sell it. WIP is work in process. These are partially completed bicycles. They're assets, because eventually we're going to finish them and then we will sell them and we will get money. So finished goods are completed bicycles. They are assets, because eventually we will sell them and we will get money. So all of these things are kinds of inventory. So this one, blank inventory, is consignment inventory. So the word is consignment. So consignment inventory refers to when you have inventory, but you don't actually own it. You're just holding it and trying to sell it for someone else. So one of the easiest examples of this is my friend Amy runs consignment sales in Salina. So I don't know if you guys know about this, because you, for the most part, don't have children, but some of you do. Kids go through clothing pretty quickly. So as an example, Andrew, he actually doesn't grow very fast, but when I buy him a pair of jeans, the kid doesn't wear jeans. He wears his school uniform pants, or he wears like sweatpants or whatever, like Nike pants. So he has to have jeans, because every once in a while there'll be a jean day at school or whatever, and I'll need him to wear a pair of jeans. Usually he'll just choose to wear his uniform pants, but anyway. So I buy the kid jeans, never wears the jeans, and then all of a sudden they're too short and he can't wear the jeans anymore. So let's say I go to Gap, I buy the kid a pair of jeans, because he only wants his jeans to be super soft, because he's like really quirky about like material. So I go buy him a pair of jeans for $25. He wears them once and then they don't fit anymore. So if I have a garage sale, which we have a garage sale every year because my kids like to sell cookies at garage sales and lemonade. It's super annoying, but whatever. And so we have a garage sale every year. If I put a pair of jeans in a garage sale, the most you're going to get out of them is $3 or $4, if you're lucky. And so sometimes you can get $3 or $4. Sometimes you get $1. Most of the time people come in and they're like, oh, I'm only going to pay $1 for that. Will you sell them for $1? And you're like, oh my gosh, they're new, but whatever. So my friend Amy created a consignment sale to help people like myself in that situation. And actually she did it for herself, because she had 3 kids and she bought like really expensive clothes for them and stuff. And they would never get used up. And so especially when they're really little and you're buying them new clothes like every 3 or 4 months. So what she would do is people like myself would drop off big buckets of clothes, and I would have to put them on hangers and I have to put a price on them. And so for those of you that are from Wichita, you may have heard of like Breeches and Lace or Mulberry consignment. This is what we're talking about. So I, as the seller of clothes, bring in boxes of clothes and I price them at whatever I want for them. So if it's a Gap pair of jeans, maybe I would put $10. Let's just say I put $10. And so what happens is I put all of my clothes in totes, I drop them off, and then she organizes them all. So she puts them all out on shelves and organizes them by gender and size and stuff. And then at the end of the week, like as people buy stuff, they keep track of what consignor sold items, and then they give me a check. So let's say those jeans sold. So I marked them for 10 bucks. She keeps 30% and I get 70%. So she's going to give me $7 and she keeps 3 for herself. And so all the clothes at the end of the week, maybe I'll get 400 or 500 bucks. And so at the end of the week though, if the clothes don't sell, she just puts them back in a bucket and gives them back to me. This is the perfect example of a consignment inventory system. So when she's holding all of that inventory, she does not own it. I still own it. She's trying to sell it for me. And then at the end of the week, if they don't sell, she just gives them back to me. She has no obligation to try to sell them. So some people think that, like, what is that place? Uptown Cheapskate, whatever that is. Some people think that's consignment, but it's not, because they actually buy those goods from you and then they sell them. So it's not consignment because they don't give them back to me if they don't sell. So they take the risk of it not being able to sell. So that's why they're really picky about what they take. My friend Amy would take anything as long as it didn't have stains and stuff. Like, she would be really kind of picky about quality. But if I said I wanted $15 for the Gap jeans, she'd probably be like, well, Nicole, those aren't going to sell, but whatever. So you can price them at whatever you want to price them at. And then if they don't sell, then you just have to take them back and try again next time. So, okay, very good. So the next item, goods in transit. So goods in transit are when goods are on their way to you. So when goods are on their way to you, the question is, who owns them? So let's see if I can find a blank Excel. I got lots of stuff going on here, but I'm going to go out here to a new Excel. And sorry, I want just a blank Excel. So let's say that today Nicole needs a Google Chromebook for my kid because they're doing all of their education online now. And so let's say that I get on the computer and I order a Chromebook. And so let's say that I order it from Dell. And so that Dell is the seller. That's Dell. And I, Nicole, am the buyer. Okay. And so if I were on the chalkboard or whiteboard or whatever it is, I would draw an arrow, and it would be kind of like a curvy arrow, like a backwards S with a little arrow. I can't do it. But anyway, I would draw an arrow that goes from the seller to the buyer's front door. And so when you're talking about goods in transit, the question is that if this happened on, let's say that I buy it today, March 29th. We'll say it's March 30th because you guys are going to look at this tomorrow. And let's say it gets here on April 3rd. Okay, so the question is, who owns it on March 31? And so let's say that Dell is doing their income statement for the month of March, and we need to know who owns it while it's on its way. So does the sale occur on March 30th or does the sale occur on April 3rd? So there are two ways to look at this. FOB, which stands for free on board, and it's just talking about who owns it in transit. So FOB, shipping point, means that the sale occurs at shipping point. So this is the shipping point right here. So that means that the sale occurs there. So that means that the sale occurs as the goods are loaded onto the truck from the Dell warehouse. It's bothering me. Okay, so that would mean that the sale occurs on March 30th. Okay, so Dell would record a journal entry on March 30th, and I would record a journal entry on March 30th. Okay, so that's what FOB shipping point looks like. So now let's do the exact same thing, and let's look at FOB destination point. That means a sale occurs at the destination, which would be my porch in Wichita. I live in Bel Air. Okay, so the sale would occur right here. So journal entries prepared on April 3rd. So the March 31 income statement by Dell would not include this transaction. Okay, because the sale wouldn't occur until right here. So that's the difference between FOB shipping point and FOB destination point. So we're talking about where does the sale occur and like who owns it while it's in transit. So that's the key item. Who owns the goods while they are in transit, which means they're on the way. Okay, so let's go back to our notes and see what it says. I would have normally written all that on the board, but here we are, right? So when other times when I've tried to explain this, we've kind of talked about like delivery pizza versus carry out pizza. So if I go to, like if I order pizza and I have them deliver it, then that means that I do not own the goods until they get to the destination. So until they hit my front porch. So if the delivery pizza guy swerves to miss a rabbit and my pizza falls on the floor, it gets ruined, they own it in transit and they are responsible for the shipping costs. And so they're responsible to replace it or whatever. But if it's FOB carry out, like FOB shipping point, then the sale occurs at the business, at the buyer's business. So FOB shipping point would be this one. So the sale would occur at Pizza Hut. I went with Pizza Hut because I'm from a small town and that's all we had. So I never eat at Pizza Hut now because I have so many other choices. And so I will always pick something else. Okay, so except for stuffed crust because it's good. Okay, so FOB shipping point means that you go to the business and you pick up the pizza. And so if I, Nicole, am driving to my house and right in here somewhere, I stop quickly and my pizza flies on the floor and it gets ruined, I own the goods in transit. So I am the buyer, I have possession of the goods, they are mine, and I would be responsible for the loss. Okay, back over here. So as we're looking at, and this is from previous chapter, I have no idea why it says that. I don't think it should. Okay, so balance sheet and income statement reporting. Remember, inventory is on the balance sheet. It's a current asset, meaning that you're not going to buy inventory 5 years worth of inventory because you'll have nowhere to put it. So inventory is a current asset. And when you buy them, you put them in an account called inventory. And then as you sell them, you remove them from inventory. So when the goods are sold, you remove them from inventory, and that's recorded as an expense called cost of goods sold. So here, I'm trying to remember if I want to show you part of the income statement or if I'm just showing you gross margin. So just a second. I want to make sure I'm recording the right thing here. This is too much. Where is it? Oh, here we go. I never really found it. I don't really know what's going on with that section of notes. I think that was when they used to have 6 and 7 combined. There used to be like a different way to organize the notes. There we go. This is what I'm looking for. Yeah, revenue minus COGS. Okay, good. And so right here, basically, like when you keep track of the cost of the good that was sold, that markup, I remember talking to you guys about this, and that's called gross profit or gross margin. So what you do is you do your revenue minus your COGS equals your gross profit. Okay, so your revenue can be called net sales, which is sales minus discounts and returns. So you might want to make a note of that. And your homework will kind of have you do that a little bit. So your revenue, like your revenue can be called sales because you can call your revenue sales, you can call it whatever you want. But net sales means that you take your sales and you subtract out any discounts and subtract out any returns. So at Walmart, if they make $1 million in sales in the store, but 50,000 of it gets returned, then their real sales are only 950. And so that's what we're talking about here. And then if we offer our customers a discount for early payment, then that reduces your revenue. Because like if you sell your revenue for $1,000, but you offer a 2% discount, then 2% would be 20 bucks. So I think, I don't know, math, it's really late. But the 2% discount would be reducing your revenue. So you would subtract it from your revenue. So you'll see it in the homework and it'll be really clear. So when you're calculating your cost of goods sold, basically you should be able to know your cost of goods sold if you're using the perpetual method, because you know as goods leave the store that they're sold and you know your COGS. But if you're using the periodic method, you know what you start with and you know your purchases. And that's called cost of goods available for sale. So we call that COGS. It's like COGS with an A. Okay, and so that's all the goods that you could sell. So if I started off with 200 bolts and then I bought 1,000 more, I could sell 1,200 bolts. And then if I only sold 800, then I have 400 left. Or if I only have 400 left, I must have sold 800. So that's kind of how that works. So when we're using the periodic method, you know what you start with, you know what you bought, you know what you end with, so then you have your cost of goods sold. With the perpetual method, we actually know what we start with, we know what we bought, and we know what we sold. So that should be your ending inventory. And then you can compare it to your actual ending inventory and see if any's missing. So at any given point at Walmart, you can use your little gun thingy. I think they called it like a 960 when I worked there, but it was a really long time ago, so I don't really remember. But you can scan an item and it should say like, you have 7 of these on hand, and then you can count them and be like, oh, I only have 6. 1 is missing. Why is 1 missing? So you might wait till the next day and see if maybe it was in somebody's cart and they were checking out or whatever. And the next day, or like at the end of the shift, at the end of the day when the business closes, Walmart doesn't close, but it does now. So you can verify your inventory balance. And if it's wrong, that's called shrinkage. It's theft. And so you would be able to figure out how much theft you have. So, all right, for sales transactions, when you sell goods, you're going to record them at their selling price. The cost is the cost of the good that you sold, and that's an expense. The gross profit is the difference. So returns and allowances, that's when you return goods. And so if your goods are returned, they're no longer sales. And so they reduce your revenue account. And so an allowance, this is an interesting thing. So like if you sell something perishable like lettuce, and Dylan's gets a shipment, a pallet of lettuce, and it's all spoiled. When you call the vendor and be like, hey, you sent me spoiled lettuce, they don't want it back. They're just going to knock it off your bill. They're going to give you an allowance for it. Or maybe you ordered bicycles for your bike shop and they sent you red ones, but you ordered blue ones. Like maybe you say, you know what, that's not what I ordered. Just take $200 off my bill. And they're like, okay. So that's called an allowance. And so it reduces your revenue. So this is where it gets interesting. Sales returns and allowances is a contra revenue. We've never had one of those. So a contra revenue means it reduces your revenue. So your revenue account has a credit balance, because all revenues are credits, because ADE are debits. And so your revenue account is going to reduce, like this account is going to reduce your revenue. So this is a debit balance. Okay, so we learned about contra assets. We know about a contra asset called accumulated depreciation, and it reduces your assets. It's like a minus in the asset section on your balance sheet. Same thing here. So sales discounts. Sales discounts are when you give the customer a discount on their purchase. And so this is an example of a discount. So 210 net 30. And so when I say that, you're like, well, what does that even mean? Well, 210 net 30 means you get a 2% discount. You get a 2% discount if you pay the balance within 10 days of getting the bill. If not, then the net whole balance is due in 30 days. So this is the maximum amount of time you have to pay. So in this example, if a sale occurred on November 1, your customer would have until November 10th to take the discount. If they waited until the 12th to pay, they would have to pay the full amount, or the 15th, all the way till the 30th. And on the 30th, that's when it's due. And after that, like we could give them like a fine for not paying or whatever. And so send them extra bills and try to fight with them and try to get our money. So So when I worked at that heating and air conditioning place, I used to buy almost all of my goods from Bedker Supply in Beloit because I could order goods up until 11:30 in the morning and I would get my shipment that afternoon. So they sent a truck over to me at noon each day with all the inventory I'd ordered. And so that was really handy. So I could order stuff up till 11:30 and get it same day. If it was after 11:30, I'd get it the next day. So, and they would deliver it to me for free. And so, because I was a really good customer. So when I got my bill, they gave me a 2% discount. And a lot of times it was like a $20,000 bill for the month. So 2% of 20,000 means I would save $400 on that balance. So instead of having to pay 20,000, I'd only have to pay 19,600. 2% doesn't seem like a lot, but when you consider that you're only holding the money, the money, like I have to pay 20,000 if I wait till like November 12th or November 30th. So is this extra time, this extra 20 days worth savings of $400? And the answer is absolutely. Okay, because when you look at like annualizing interest and stuff, it is always a good idea to take the discount. So let's go ahead and do some journal entries. So on March 3rd, gooddeal.com sold inventory costing $2,000 for $2,500, terms 210 and 30. The customer paid for merchandise on March 6th, taking advantage of the permitted discount. So let's first do the journal entries on March 3rd. So we sold inventory and we're going to receive the money later. The goods left the building. So this is our first time I think we've seen this journal entry. So what's happening here is we're selling inventory. So what I'm going to do is I'm going to do accounts receivable. Oh, I think I did an extra one. Now I have to start over. Okay, and so we're going to debit accounts receivable. Now the sale, the money we're going to receive from the customer is eventually going to be $2,500, I think. And the cost of the good that was sold is $2,000. So we're going to debit COGS and credit inventory. So anytime we sell inventory, we're going to do 2 journal entries. And so we're going to do 2 journal entries because we sold it for $2,500, but then the goods left the building. So we're going to have the money coming in and the goods going out. So it's important to realize that they gave you $2 amounts. You're going to use both. We can calculate our gross profit on this transaction right now at $500. Revenue minus COGS is gross profit. That's your markup. So we made $500 on this sale. Now, when we do this journal entry on March 3rd, we do not know if Good Deal is going to take the discount or not take the discount. So at this point, we assume they are not, and then we see and wait and see what happens. Now, they chose to take the discount. So when we receive money on March 6th, we are not going to get $2,500. So 2% of $2,500 is $50. So when we get money from them, we are only going to get $2,450. I thought we were going to get $2,500, but I'm only getting $2,450, and that's legit. They don't owe me another $50. So if they would have sent me $500 in the mail, I'd be like, hey, you still owe me $2,000. But they sent me $2,450. They took advantage of the discount. So what students want to do, so don't do this, but what students want to do is they want to credit accounts receivable for $2,450. And if you do that and you stop and that's all you do, then it looks like your balance in accounts receivable is $50. So it looks like the customer still owes you $50. And so if next month you send a bill to Good Deal for $50, they're going to be pissed. They're going to be like, hey, you offered me a discount. I paid by the 6th. Why are you sending me another bill? So you may not only credit accounts receivable for $2,450. You have to use the full $2,500. And now it's clear that Good Deal no longer owes us any money. But can we be done? No, we cannot be done because our debits and credits do not equal in this transaction. I have a $2,450 debit and a $2,500 credit. So I need another $50 here, which reflects our discount. So this account is called sales discounts. Could put an S, I don't care. And so basically this account is called a contra revenue. So that's what kind of account this is. Contra revenue debit balance. Okay, so our net sales in this particular transaction, I don't know if I can write right there or not, but clearly I guess I can't. So I would like you to write it at the bottom of that page, but it's not really working out for me. Net sales would be revenue minus discount. So you would do 2,500 minus the $50 discount, and your sales are actually 2,450. And then you could, from there, subtract COGS to get $450, and that number is called gross profits. Okay, so you'll actually do this kind of stuff on your homework on your first sheet, and I have the formulas over to the side, but that's literally what you're doing. You're calculating out what the net sales are. So net sales are your sales minus your discounts and returns, and then you subtract out COGS to get your gross profit. So, okay, so what is net sales? And so this is just a place for us to go ahead and fill in what the definition of net sales is. We're almost done, by the way. So this net sales is sales minus your returns and discounts, and that's your net sales. So you just take your sales and you subtract out any discounts and returns, and that's where we got 2,450 up here. We didn't have any returns. So after you get to net sales, you can go ahead and you can build an income statement. And so you start off with net sales and you subtract COGS to get your gross profit. So I'm going to actually just delete all of this and write it myself. So I'm going to start with my net sales, and then I'm going to subtract my COGS. I don't want you to do that. Minus COGS to get my gross profit. Sometimes I call that gross margin. That means the same thing. Okay. And then from there, we're going to subtract out our operating expenses. So those are going to be like your regular expenses, like rent and stuff. Okay. And that's going to give us our net income before taxes. So you can call that NIBT. And then from there, we'll subtract out our taxes. So we can call that tax expense to get net income. So this is our new formula for our income statement. So I made reference to this last time we were there, and I was like, remember the good old days? And I was like, what's the formula for the income statement? And you're like, revenue minus expenses. And I'm like, oh, yeah, that's the easy way, isn't it? And it's still the way, because COGS is an expense. So we're going to take our net sales and we're going to subtract out this expense, and then we'll subtract out these expenses, and then we'll subtract out this expense to get net income. But we just subtotal, because you as an investor would like to see what the markup is. You as an investor would like to see what the taxes are based on your net income before taxes, because then you can see what rate they pay for taxes. And so this is all just a very handy thing. And then on this bottom number, we would double underline it, because that's what we do, right? So this here is just an example of what we just did. So these are our operating expenses: selling, general, admin, and so on. And so we can have another subtotal for other expenses. I didn't in mine, but it's okay either way. So that is it for our notes. And so I'm going to hit stop share, and I'm going to post these, and then you're going to be able to do the chapter 6 homework. And so the chapter 6 homework, I think there's 3 tabs, and I want you to do all 3. And then you guys can email or text those to me by next time at 10 a.m. So you guys have a great day, and I will talk to you soon. Thanks. Bye.